How do US firms handle CPP contributions? What CPP actually is in this context? The Canada Pension Plan is a mandatory public pension program that covers most workers outside Quebec. Employers and employees both contribute a percentage of earnings up to an annual limit. For a US firm with Canadian employees, CPP contributions are not a nice extra. They are part of the basic cost of employing people in Canada. The question is how to plug CPP into systems and habits built around US Social Security and retirement plans. When CPP applies to your Canadian staff, CPP applies when an employee works in pensionable employment in Canada and is not covered by a specific exemption. If your US company hires someone who lives and works in Canada as an employee, that work is usually pensionable under CPP. It does not matter that you are headquartered in another country. Once you are on the hook as an employer for Canadian payroll, CPP is almost always part of the package unless international social security rules say otherwise for a particular assignment. International agreements and certificates of coverage. There are social security agreements between Canada and the United States that prevent double contributions in some cross-border situations. For example, an employee temporarily assigned from the US to Canada may remain covered by US Social Security and be exempt from CPP for a limited period as long as specific conditions are met. In those cases, a certificate of coverage from the US side is used to show Canadian authorities that CPP contributions are not required. Where US firms often get tripped up is assuming that this exemption applies to every situation. It does not. Remote hires who live permanently in Canada but happen to be on a US payroll generally do not fall into that category. For them, CPP is usually expected. Integrating CPP into payroll systems. Once you accept that CPP applies, the main job is to build it into your payroll process. That means your payroll calculations must determine which earnings are pensionable, apply the current CPP rate, and split the contribution between employee and employer shares. Both pieces must be remitted along with income tax and EI. On pay stubs, CPP shows up as a separate line item so employees see their own contribution clearly. If you are using a Canadian payroll provider, they will usually handle the math and updates as rates change each year. If you are trying to run Canadian payroll through a US-centric system, you need to make sure CPP is not treated as just another deduction, but as a specific mandatory contribution with its own rules and annual maximums. Handling CPP for different types of workers. Not all workers are treated the same way. Very low-earning employees may have small or no CPP contributions in practice because of basic exemptions. Some roles may be excluded under specific rules. If you have a mix of part-time, seasonal, and full-time staff, CPP behavior can differ among them. The key for US firms is not to hard-code assumptions from US Social Security into Canadian payroll. Instead, you let the Canadian logic run and treat the output as the truth for that jurisdiction. CPP versus private retirement plans. CPP does not replace private retirement savings plans or employer pension plans. It sits underneath them. Some US firms like to offer Canadian employees access to a registered retirement savings arrangement or a group plan in addition to CPP. That can help with recruiting and retention, but those private plans do not change CPP obligations. You do not get to opt out of CPP just because you offer a generous 401k style plan with employer match. Reporting and year-end considerations. At year-end, CPP contributions must be reflected correctly on T4 slips. The total employee contributions you report on those slips should match what was actually withheld and remitted. If your remittances show one number and your slips show another, you will spend time untangling the difference. US firms that treat CPP as a side detail sometimes discover at year-end that their coding was off and that they need to adjust both remittances and slips. Budgeting for CPP is a real cost. For workforce planning, CPP should be treated as a real employer cost, much like the employer share of US Social Security. When you model what it costs to hire in Canada versus the United States, you include gross salary, employer CPP contributions, employer EI, workers' compensation where applicable, and any benefits. That gives you a more accurate comparison than using salary alone. Final thoughts. US firms handle CPP contributions successfully when they stop treating them as an optional add-on and start treating them as core to Canadian payroll. That means understanding when CPP applies, using international agreements correctly rather than casually, integrating contributions into payroll calculations, and reporting them cleanly at year-end. Once CPP is built into your system, it becomes just another predictable part of employing people in Canada. If you want a simple framework for modeling CPP and other payroll costs when you compare Canadian and US hires, you can find more practical material at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.